All right, so are you ready to dive into some bold claims about no-brainer stocks?
Always up for a challenge.
Okay, good. Because the Motley Fool put out an article on December 27th, 2024.
Oh, yeah, I saw that one.
Yeah, and they handpicked 3 companies they say you could invest $1,000 in and basically just hold forever.
Forever, huh?
Yeah. Now, I'm always a bit skeptical of anything claiming to be a sure thing in the world of investing.
Right.
So I've brought in an expert to help us unpack this.
Well, I think a healthy dose of skepticism is always wise when it comes to investing. Let's dive into these picks and see if they really live up to the hype.
Sounds good to me. So the Motley Fool's first pick is a familiar name, at least for anyone who's dipped their toes into the investing world, Berkshire Hathaway.
Ticker symbol BRKB.
Exactly. And of course, we can't talk about Berkshire Hathaway without mentioning the Oracle of Omaha himself, Warren Buffett.
It's true. Warren Buffett and Berkshire Hathaway are practically synonymous with long-term investing success.
Yep.
The article really emphasizes that buy and hold forever approach, which aligns perfectly with Buffett's philosophy.
And his track record is pretty hard to argue with, right? Nearly 20% average annual return since 1965. I mean, that's seriously impressive. But what's the magic formula here? Is it just him picking winning stocks, or is there something more to it?
Well, stock picking is certainly part of the equation.
Yeah.
But one of the key factors behind Buffett's success is the power of compound interest. It's like a snowball effect. Your returns get reinvested, and then those returns generate even more returns, and so on. Over decades, that compounding can lead to truly extraordinary growth.
So it's about letting your investments grow over time, not trying to time the market or chase short-term gains. Got it. Now let's talk more about Berkshire Hathaway itself. It's not your typical company, is it?
You're right. It's not just a single business. It's a massive conglomerate. Think of it like a giant basket holding a diverse collection of companies across various industries. You've got railroads, utilities, insurance companies, consumer goods, brands. You name it, they probably own a piece of it.
Okay, so diversification is a big part of their strategy. I can see how that would be appealing, especially when the economy feels a bit shaky.
Absolutely. Diversification is a classic way to manage risk. If one sector is struggling, others might be thriving. It helps them weather those economic storms.
And speaking of economic storms, the article highlights that Berkshire Hathaway's largest holdings are actually in insurance. They're the second largest property and casualty insurer in the U.S.
Wow.
That seems like a pretty strategic move.
It is. Insurance, particularly in the property and casualty sector, tends to be quite resilient even during periods of inflation.
Okay.
Here's why. As prices rise, the value of the things people insure, their homes, cars, businesses, also goes up. This leads to higher premiums for insurance companies.
So even when things are getting more expensive, they're bringing in more money. Interesting. But they're not just sitting on a pile of insurance premiums, are they?
Nope.
The article mentions they have massive cash flow and a ton of money invested in short-term treasuries. Those numbers were honestly a bit mind-boggling.
You're right to focus on that. Berkshire Hathaway generated over $21 billion in free cash flow in the last 12 months. And they've got a whopping $288 billion stashed away in short-term treasuries.
Wow.
This financial strength is a key reason they're considered such a safe bet.
Okay, but what does all that cash actually do for investors?
Think of it this way. It gives them incredible flexibility and firepower. They can use that cash to invest in new opportunities, acquire other promising businesses, buy back their own stock, or simply ride out any economic turbulence. All of these things can potentially boost returns for long-term investors.
So it's like they're a massive, well-funded ship built to withstand even the roughest seas. All right, I'm starting to see the appeal here. But before we jump to conclusions, the Motley Fool has another no-brainer stock on their list, and this one seems to have a very different strategy.
Let's dig into that next one.
The next company is Progressive, ticker symbol PGR.
Okay.
And they're also in the insurance business, but their approach seems a bit counterintuitive. The article talked about how they prioritize underwriting profit over simply gaining customers.
Interesting.
So they're not just trying to insure everyone who walks in the door.
You've hit on a key point here. Progressive is known for its disciplined underwriting. Instead of chasing market share at all costs, they focus on insuring customers who are statistically less likely to file claims. This might seem like it would limit their growth, but
it actually leads to higher profitability, right?
Yeah.
They're being very selective about who they insure.
Exactly. And the numbers seem to back this up. The article highlights their impressive 3-decade return of 18.4% annually, which is significantly higher than the overall market.
That's pretty remarkable, but is that all due to their underwriting strategy, or are there other factors at play?
Well, their disciplined underwriting is a key differentiator, but they also benefit from the general upward trend of the U.S. economy.
Okay.
The article even points out that the U.S. has been in a recession for only about 15% of the time in the last 70 years.
Wow.
When the economy is doing well, people tend to buy more cars, homes, and other insurable assets, which is good news for Progressive.
So they're riding that wave of economic growth, but with a safety net of carefully chosen customers. It's like they've got a double layer of protection.
Wow.
But wait, there's more. Right, they're not just making money from insurance premiums. The article mentioned a huge investment portfolio that's generating billions in income.
That's another piece of the puzzle that makes Progressive so interesting. They have a massive investment portfolio worth nearly $80 billion, which brought in $2 billion in net investment income this year alone. That's a 47% increase from last year.
Whoa, a 47% jump? That's huge. What's driving that kind of growth?
A big part of that increase is due to rising interest rates. As interest rates go up, the returns on their investments also climb, which adds to their overall profitability.
So they're winning on both ends, the insurance side and the investment side. Okay, I'm really intrigued by this company now. But we've got one more no-brainer to unpack from the Motley Fool's list, and it's a brand most of us probably interact with on a regular basis.
Let's see what they have to say about this final pick.
All right, the last company on the list is American Express, ticker symbol AXP.
Great.
Now, this is a brand known for its luxury image and premium rewards. Is that really what makes them a no-brainer investment?
Well, that brand recognition and association with exclusivity are definitely valuable assets. Think about it. Even though they're competing with giants like Visa and MasterCard, American Express has managed to carve out a unique niche in the market.
So it's about targeting a specific type of customer, the kind who values premium services and is willing to pay for them.
Exactly. And that customer loyalty can be a huge advantage, especially during times of economic uncertainty.
Speaking of loyalty, I loved that anecdote in the article about Warren Buffett's long-term faith in American Express. He's been holding it in Berkshire Hathaway's portfolio for 30 years, and his initial investment of $1.3 billion has grown to over $41 billion. That's insane.
It's a remarkable example of the power of believing in a company and its long-term potential. But it's not just about brand loyalty. The article makes a case for American Express being well-positioned for both economic growth and inflation.
Okay, I'm curious about that. How can a company benefit from both a booming economy and rising prices? Those seem like opposite scenarios.
It's all about how people spend money. In a growing economy, people tend to have more disposable income, and they're more likely to use their credit cards.
Okay.
And during periods of inflation, the dollar value of transactions goes up, which means higher revenue for American Express.
So it's like they're hedged against different economic conditions. That's pretty clever. But before we get too carried away with this no-brainer talk, I have a feeling there might be some potential downsides to these seemingly perfect companies.
You're absolutely right to be thinking that way. No investment is without risk.
Let's take a closer look at those potential risks when we come back. All right, so we've explored the sunny side of the street with these three no-brainer stocks. But as we all know, no investment is completely risk-free. Let's put on our skeptical hats for a minute and explore some potential downsides or concerns investors might want to consider.
Yeah, that's always a good idea. It's important to look at both sides of the coin before making any investment decisions.
So let's start with Berkshire Hathaway. What are some of the potential shadows lurking behind this seemingly invincible giant?
Well, one of the biggest elephants in the room is Warren Buffett's age.
Yeah, true.
He's over 90 years old. And while he's still incredibly sharp, the question of succession is unavoidable.
Yeah, I can see how that would be a major concern for investors. Berkshire Hathaway has been so closely tied to his leadership for decades. It's hard to imagine it without him at the helm.
Exactly. And while he has a talented team in place, it remains to be seen if they can maintain his remarkable track record. There's also the sheer size of Berkshire Hathaway to consider.
Right.
It's a massive, sprawling conglomerate, which can sometimes make it slow to adapt to rapid market changes.
It's like trying to turn a giant ship. It takes time and a lot of coordinated effort.
Precisely, that lack of agility could potentially put them at a disadvantage in a fast-moving market.
Okay, so succession and size are two key things to think about with Berkshire Hathaway. Now let's shift gears to Progressive. What potential potholes should investors be watching out for with this company?
Well, one thing that always comes up with insurance companies is competition. The industry is fiercely competitive, And Progressive is constantly battling with rivals like Geico, State Farm, and Allstate, just to name a few. They need to constantly innovate and find ways to stand out from the crowd.
And it's not just competition from other traditional insurance companies, right? We're seeing a wave of insurtech startups disrupting the industry using AI and data analytics to change the game.
You're absolutely right. Progressive needs to stay ahead of the technological curve to remain competitive. Another potential risk is the cyclical nature of the insurance business itself.
Okay.
Profitability can be affected by things like natural disasters, economic downturns, and even changes in regulations.
So while they've historically done a great job of managing those cycles, there's always the possibility of unexpected events that could throw a wrench in the works.
Exactly. Unforeseen events are always a possibility, and that's part of the inherent risk in investing.
All right, let's move on to our final company, American Express. What are some of the cracks in their seemingly polished armor?
Well, one thing to consider is their reliance on a relatively affluent customer base.
Right.
They're known for their premium cards and rewards programs that cater to higher-income individuals.
Right, it's part of their brand identity. But could that actually be a vulnerability?
It could be, especially during an economic downturn. If their core customer base is disproportionately affected by job losses or reduced spending, it could impact American Express's revenue.
It's like that old saying, don't put all your eggs in one basket.
Exactly. Another challenge they face is the rise of alternative payment methods.
Oh, yeah.
Think about the growing popularity of mobile wallets, peer-to-peer payment apps, and even cryptocurrencies.
It feels like there's a new payment option popping up every week. It's definitely a crowded landscape.
American Express needs to adapt and evolve to stay relevant in this rapidly changing payment landscape.
So it's not just about maintaining their premium brand image. They also need to innovate and find ways to attract new customers while keeping their existing ones happy.
Precisely. And here's another factor to consider. American Express typically charges higher merchant fees compared to Visa and MasterCard.
So businesses have to pay more to accept American Express cards.
That's right. And while many businesses are happy to pay those fees to attract American Express's affluent customer base, it could become a sticking point if the economy weakens or if merchants start pushing back against those higher fees.
That's definitely something to keep in mind. Okay, so we've poked some holes in the Motley Fool's no-brainer argument. It seems like there's a lot more nuance here than they initially presented.
I agree. It's never as simple as it seems.
But we've only heard one side of the story so far, right? We focused on the Motley Fool's perspective, which tends to be quite bullish. What about other analysts or investors who might have a different take on these companies?
That's an excellent point. It's always important to seek out diverse perspectives and not rely on a single source of information. And yes, there are definitely some analysts who are more cautious or even downright bearish on these stocks.
Well, all right, let's dive into that. Starting with Berkshire Hathaway, what are some of the arguments against investing in BRKB?
Well, the succession issue we touched on earlier is a major concern for some analysts. They worry that Warren Buffett's eventual departure will create uncertainty and potentially hurt the company's performance.
It's tough to imagine anyone filling his shoes.
There's also the concern that Berkshire Hathaway's immense size could become a drag on its growth. It's simply harder for large companies to grow at the same pace as smaller, more nimble competitors.
It's like the law of diminishing returns.
Exactly. And some analysts believe that Berkshire Hathaway might struggle to find enough attractive investment opportunities that can move the needle for a company of its size.
So it's not just about finding good investments. They need to find massive investments that can make a significant impact on their already huge portfolio.
Precisely. Now let's turn our attention to Progressive. Some analysts are concerned about the increasing pressure on profit margins in the insurance industry as a whole.
Right. We talked about the fierce competition from both traditional rivals and these new insurtech players. That's got to be squeezing their profits.
Exactly. As competition intensifies, it could force Progressive to lower prices or increase advertising spending, both of which could eat into their profit margins.
So they're caught between a rock and a hard place in a way.
You could say that. And there's another wild card that some analysts are worried about: the potential impact of autonomous vehicles on the insurance industry.
The self-driving car dilemma. It seems like we hear about this in every industry these days, but how would it actually affect an insurance company like Progressive?
Well, the thinking is that if accidents become less frequent because of self-driving cars, there will be less demand for car insurance.
Makes sense. But isn't that still a pretty far-off scenario? We're not all going to be cruising around in self-driving cars next year.
You're right, widespread adoption of autonomous vehicles is still probably a ways off. But it's a long-term trend that progressives will need to figure out how to navigate.
So it's not an immediate threat, but it's something they need to be thinking about and preparing for.
Absolutely. And lastly, let's circle back to American Express. One of the main bearish arguments against them is that they're losing market share to Visa and MasterCard, particularly in the debit card space.
Right. Those two companies are pretty much ubiquitous. You see their logos everywhere.
Exactly. They have a much wider reach, especially for everyday transactions. And some analysts believe that American Express's focus on the premium segment might actually limit their growth potential in the long run.
So while their brand loyalty is strong among those higher-income customers, they might be missing out on a much larger slice of the market.
That's the concern, and there's also the looming possibility of increased regulation.
Regulations. How would that affect a credit card company like American Express?
There's been talk of capping interchange fees, which are the fees merchants pay to credit card companies for processing transactions. If those fees are capped, it could significantly hurt American Express's revenue, since they rely more heavily on those fees compared to some of their competitors.
So it's a kind of regulatory risk that investors need to be aware of.
Exactly. It's a potential wild card that could have a significant impact on their profitability.
Okay, so we've heard the good, the bad, and the potentially ugly. It seems like the Motley Fool's no-brainer label might be a bit of an oversimplification.
I think that's a fair assessment.
Yeah.
There's a lot more to consider than just a catchy headline.
But ultimately, isn't the decision of whether or not to invest in these companies up to each individual investor?
Absolutely. It all comes down to your personal financial goals, your risk tolerance, and your own research and due diligence. But I think the Motley Fool's article has served a valuable purpose. It's got us talking about long-term investing, exploring different companies, and thinking critically about the potential risks and rewards.
It's definitely sparked a fascinating conversation. But before we wrap up our deep dive, I'm curious to hear your thoughts on one more thing. After hearing all the arguments for and against these companies, do you still think that no-brainer label holds any weight at all?
That's a great question, and honestly, I think the term no-brainer is a bit misleading in this context.
Yeah.
As we've seen, there are valid arguments on both sides.
Okay, so we've dissected the Motley Fool's picks and heard from the bulls and the bears.
Right.
And even poked a few holes in their no-brainer argument.
We did.
But let's step back for a second and consider the source itself.
Okay.
The Motley Fool is known for their, let's say, optimistic take on the market.
They certainly have a reputation for finding those hidden gems and beating the market.
Right. And their enthusiasm is infectious, but it's important to remember that their recommendations might be colored by their overall philosophy.
Yeah, I see what you mean.
It's like reading a restaurant review from someone who loves spicy food.
Okay.
You might want to adjust your expectations if you prefer milder flavors.
That's a great analogy, and it highlights the importance of taking any investment advice, even from reputable sources, with a grain of salt.
Absolutely.
Yeah.
Always do your own research. Weigh the pros and cons and make sure any investment aligns with your personal goals and risk tolerance.
Definitely.
Which brings us to the most important part of this deep dive. You, the listener.
That's right.
We've spent a lot of time talking about Berkshire Hathaway Progressive and American Express.
We have.
But how can you actually apply this knowledge to your own investment decisions?
Well, I'm glad you asked. The first step is to really define your investment goals. What are you hoping to achieve with your investments?
Right.
Are you looking for long-term growth? Are you more interested in generating income?
Yeah.
Or perhaps a combination of both?
Right. Everyone has different financial objectives and different timelines. Some people are investing for retirement, decades down the road. Others might be saving for a down payment on a house.
Yeah.
And some might be looking for ways to supplement their current income.
Exactly. And once you have a clear understanding of your goals, you can start to evaluate whether these companies, or any companies for that matter, fit into your overall investment strategy.
So, for example, if someone's primary goal is steady long-term growth and they're comfortable with a bit of risk,
Yeah.
Berkshire Hathaway, with its diversified portfolio and proven track record,
Right.
might be a good fit.
That's one possibility.
Yeah.
But if someone is more focused on generating income and they're a bit more risk-averse,
Okay.
Progressive, with its history of dividend payouts and the potential for rising investment income, might be a better option.
And if someone is looking for a company with a strong brand,
Right.
a loyal customer base, and a knack for navigating economic ups and downs,
Okay.
American Express could be worth considering. But again, it all comes back to your individual goals and priorities.
Now, another crucial factor to consider is your risk tolerance.
Yes?
How comfortable are you with the possibility of your investments going down in value?
Right. Some people are perfectly fine riding those market waves, while others get queasy at the slightest dip.
It's all about finding what you're comfortable with. And it's important to remember that all investments carry some level of risk. It's crucial to understand the potential downsides before putting your hard-earned money on the line.
So if someone's risk-averse, they might want to diversify their portfolio across multiple companies and sectors rather than putting all their eggs in one basket.
Right.
They might also want to consider a mix of stocks and bonds to balance risk and potential returns.
Those are all great strategies for managing risk. And I think it's important to touch on one more aspect, which is often overlooked.
Okay.
The psychological side of investing.
Ah, yes, the emotional roller coaster. It's one thing to understand the numbers, but it's another thing entirely to keep your cool when the market takes a dive.
It's easy to get caught up in the hype, especially when you hear buzzwords like no-brainer or guaranteed returns.
But as we've discussed throughout this deep dive, investing is a marathon, not a sprint.
Absolutely.
It's about making informed decisions, staying patient, and not letting your emotions dictate your actions.
Well said. It's about having a plan and sticking to it, even when things get turbulent. Don't panic and sell when the market drops, and don't get greedy and overextend yourself when the market is soaring.
Stay disciplined, stay focused on your long-term goals,
Right.
and remember that time is your greatest ally in the world of investing.
So as we wrap up our deep dive into these no-brainer stocks, what are some final thoughts you'd like to leave our listeners with?
Well, first and foremost, I hope our listener feels more informed and empowered to make their own investment decisions.
Me too.
We've explored the good, the bad, and the uncertain, but ultimately it's up to each individual to decide what's right for them.
It's been a truly fascinating exploration. And remember, knowledge is power. The more you understand about the market, the better equipped you'll be to navigate its complexities and achieve your financial goals.
And don't be afraid to seek guidance from a qualified financial advisor if you need help creating a personalized investment plan.
Excellent advice. All right, that's a wrap for this deep dive into the world of long-term investing.
Thanks for joining us on this journey of discovery.
Until next time. Happy investing.